So just remind me the last thing that we did so that we proceed from there. Someone to remind me the last item that we did. So you are to do the November 2019 question 5 part B. So they are saying you are to do the question for November 2019, question number 5 part B. So let us go through that question 5 part B for the sitting of November 2019, November 2019, question number 5 part B. So the question reads that A Limited and B Limited are companies operating in the same line of business. So in the past few years, A Limited has experienced stiff competition from B Limited to an extent that A Limited is now contemplating acquiring B Limited in order to consolidate its market share. So the following financial data is available about the two companies. So there is A Limited and B Limited. Annual sales was given, net income was given, ordinary shares outstanding was given, earning per share, also the market price per share. So both companies are in the 30% income tax bracket. So required, they wanted you to get the maximum exchange ratio that A Limited should agree to, assuming that it does not expect dilution in its post-acquisition earning per share. Roman letter 2, total premium the shareholders of B Limited will agree to receive at the exchange ratio in part B, Roman letter 1 above. Roman letter 3, A Limited post-acquisition earning per share, assuming that the two companies will agree on an offer price of 30. Then finally, A Limited post-acquisition earning per share, assuming that for every 100 ordinary shares of B Limited, the shareholders are offered to 12% debentures of shillings 100 per value. So we can start off with the Roman letter 1. That Roman letter 1 is maximum exchange ratio that A should agree to, assume that it does not expect dilution. That's the same as non-diluting offer price. So the question should be on page 36 or page 35. It is on page 35. The question is on page 35. So let us do that Roman letter 1. So they are asking you maximum exchange ratio that A should agree to. So exchange ratio. So exchange ratio, it is supposed to be given by offer price, by the predator. The offer price by the predator. The offer price by the predator. We divide by market price per share of the predator. Market price per share of the predator. But the offer price must be non-diluting offer price. The offer price should be non-diluting offer price. So non-diluting offer price, non-diluting offer price should be equal to the price earning ratio of the predator. Before acquisition, then multiplied by earning per share of the target, also before acquisition, earning per share of the target, earning per share of the target, also before acquisition. So you remember the price earning ratio is simply market price per share divided by the earning per share. So price earning ratio is simply market price. Market price for the predator, it is given as 60. So earning per share for the target for the predator is 4. Then multiplied by earning per share of the target. So earning per share of the target is given as 3. It is given as 3. So when you compute, it should now be able to give you what is supposed to be the non-diluting offer price. So if we come up with what is supposed to be the non-diluting offer price. Get what is supposed to be the non-diluting offer price. So you are getting 45. So you are getting 45. So after that, now you are getting that non-diluting exchange ratio. So the exchange ratio, you take the 45, which is now non-diluting offer price, then you divide by market price per share of the predator, which is 60. So we can now get that ratio. Let us now get that ratio. Get now that ratio. So get the ratio from there. So it is 3:4. The ratio is 3:4. So we comment that this implies that the predator will issue 3 shares. It implies that the predator will issue 3 shares in order to acquire 4 shares of the target. This implies that the predator is issuing 3 shares in order to acquire 4 shares of the target. In order to acquire 4 shares of the target. So that is now the Roman letter 1, where they were asking you maximum exchange ratio that A Limited should agree to, assume that it does not expect dilution in its post-acquisition earning per share. So it does not expect dilution in the post-acquisition earning per share. So that is now our Roman letter 1. We now go to the Roman letter 2, where the question wanted you to get the total premium that the shareholders of B Limited will agree to receive at the exchange ratio in B, Roman letter 1 above. So let us see now how to get the share premium. So to compute the share premium, so to calculate the share premium is supposed to be given by the share premium is supposed to be given by the offer price. The offer price, we subtract the market price per share of the target. Market price per share of the target. So the offer price is what you have calculated as 45. Then you subtract the market price per share of the target, which is B Limited. They gave you 30. So it is going to give you 15. So that the total share premium, will now be given by 15 multiplied by the shares of the target at the exchange ratio. You simply take that 15 multiplied by the shares of the target at the exchange ratio, which was 4. Yeah, so that is now what should be our Roman letter 2. That should be your Roman letter 2. Now we go to the Roman letter 3. Roman letter 3 is supposed to be a limited post-acquisition earning per share, assuming that the two companies will agree on an offer price of 30 shillings. They will agree on an offer price of 13 shillings. So that Roman letter 3 is share for share exchange. The Roman letter 3 is meant to be the share for share exchange. So Roman letter 3 is meant to be the one for the share for share exchange. So Roman letter 3 is share for share exchange. Roman letter 3 is share for share exchange. Share for share exchange. So share for share exchange, when it comes to the share for share exchange, to compute earning per share of the aggregator, it is supposed to be given by the combined earnings. Combined earnings of the aggregator and the target. Of the aggregator and the target. Then you are supposed to divide by existing number of the ordinary shares of the aggregator. Existing number of the shares of the aggregator. So you are supposed to add the new shares to be issued to acquire the target. New shares to be issued to acquire the target. New shares to be issued to acquire the target. So first, we compute now the new exchange ratio, because the question had given you the new offer price. So you simply take the offer price. Offer price divided by market price per share of the aggregator. So the new offer price as per the Roman letter 3, they were offering 30 shillings. So divide by the current market price per share of the Predator, which is 60. Zero 0.5. Yeah, so it is 0.5 is to 1. So it is the same as 1 is to 2. It is the same as 1 is to 2. Then now we get the number of the new shares to be issued. So number of the new shares to be issued. So 1 share is equivalent to 2 ordinary shares. Like that. 1 share is equivalent to 2 ordinary shares. So that 1 share, so we want to acquire B Limited. So B Limited has ordinary shares outstanding of 3 millions. So it had 3 million ordinary shares. So how many shares were to be issued? So how many shares are to be issued? So 1.5 million. So they issue 1.5 million shares. So now we can compute earning per share of the Predator. Simply take combined earnings. You add the earnings of the Predator and the target. So the net income, you add 40 millions. Then you add the 9 millions. So you divide by existing number of ordinary shares for A Limited, there were 10 millions. Then add 1.5 million shares to be issued. So that now should be able to give you the post-acquisition earning per share of the Predator. So combined earnings, you simply add the net income. There is 40 at 9 millions. Then existing number of the ordinary shares of the Predator are 10 million. The new shares to be issued is 1.5 millions. Six. 4.26. Online, you are getting which figure? 4.2. So we go to the Roman letter 4, where they asked you to calculate A Limited earning per share, assuming that for every 100 ordinary shares of B Limited, shareholders are offered 12% debenture option is 100 par value. So that Roman letter 4 is using of the debentures. Well, now we use the debentures. The Roman letter 4 is about use of the debentures. So when it comes to the Roman letter 4, it's all about use of the debentures. Using debentures. So when you are using debentures, So you divide by the number of the ordinary shares of the predator. Divide by the number of the ordinary shares of the predator. So you need to come up with the number of the debentures. You should be able to come up with number of the debentures. You should get the number of the debentures. Number of debentures. So to get the number of the debentures, when you want to get the number of the debentures, so what you have been given is that for every 100 ordinary shares, you will be offered 2 debentures. So 2 debentures is equivalent to 100 ordinary shares. 2 debentures will be equivalent to 100 ordinary shares. So the target had 3 million ordinary shares. So how many debentures? So how many debentures will be there? Debentures are 60,000. So from there now you compute interest. So interest, get 60,000 debentures multiplied by the bar value. Multiplied by the bar value of each debenture, which is 500. Then the interest rate is 12%. The interest rate is 12%. So what should be our debenture? 3.6 million. So now to compute. Per share of the predator. So combined earnings will remain the same. The combined earnings will be 40 million plus 9 millions. So interest is 3.6. Interest tax benefit, you simply take 3.6 million, multiply 0.3. Then divide by the number of the ordinary shares of the predator. Each one 10 millions. That formula, Adam, you have it in your book. There was no need of me even writing it on the board. There was no need for me to write this formula on the board because I have repeated it so many times in your book. So even if you don't see what is here, check in your books. When we are using debentures, how do you get the earning per share of the predator? That formula is there in your book so many times. The first question I did, I had written the formula. Even when I was teaching, I gave you those formulas. So they are there in your notes. They are there in your notes. When you are using debentures, how do you get the earning per share? So it is giving us which figure? 4.648. 4 points. Online, you are getting which figure? Anyone who has computed online, you are getting which value? 4.648. So that is now all for that portion. So I'd given you some other handouts about restructuring and reorganization. I gave you some notes on the restructuring and reorganization. Are you able to see the notes for the restructuring and the reorganization? Because that is now where we should go to. So let us now go to restructuring and reorganization. It is still part of the mergers and acquisition. So do you have the notes for the restructuring and the reorganization? Yes, it was shared. Online, can you see the notes for restructuring and the reorganization? Are you able to access those notes? And now I want to let me know whether you can see the restructuring and the reorganization. Sorry. So let us now go to restructuring and reorganization. Let us now go to restructuring and reorganization. So when it comes to restructuring or reorganization, they have stated that it is the process of changing the capital structure of the company, and it is carried out as part of the corporate restructuring. So corporate restructuring is as a result of the change in the capital structure, operations, changes in the core business activities, and also changes in the assets of the company, and also change of the management team in order to improve the value, in order to improve the value, in order to improve the value, in order to improve the value of the company and enhance the shareholders' returns. So that is what we mean by restructuring. There are several types of restructuring. There is financial restructuring, portfolio restructuring, and organizational restructuring. So there is information given there for financial restructuring, where you simply change the capital structure of the company, and it is normally carried out by companies which are facing financial problems. So I've given the reasons for financial restructuring. I've also given the types of the financial restructuring skills. Then there is also business reorganization. There is also business reorganization, where we say that it is a process which involves a change in the organization of the business, change in the assets of the business and the workforce in order to improve the operations of the business. So I've given you objectives. It is important because of those reasons. There are 4 of them. And I've also given the objectives of the reorganization and types of the reorganization. So I would like you to read through those terms. That small handout they normally examine it so much. So I will only refer to you some of the questions in the past papers in relation to that. Like now, if you happen to go to the sitting of the question for the last sitting, that is August 2022, August 2022, if you check question number 4, question number 4, starting with part A and part B. Question number 4, if you check part A and part B, so that question number 4, part A, they had said that assess 4 circumstances under which the company would consider reorganizing its operation rather than liquidating. You see that question? They are saying that explain assess 4 circumstances under which the company would consider reorganizing its operation rather than liquidating, reorganizing. So those are basically the reasons for reorganizing. Like now, if you check through what we have written there about business reorganization in that handout, they have said that it is important because A, enhance the performance of the business. Number 2, tackle competition in the market. Then reduce operating cost of the business. Then solve the existing problems in the functioning of the organization. But I've given you the objectives of reorganization. So in order to reduce the tax, after-tax cost of borrowing, then improve the security of finance, then clean the balance sheet of the organization, so settle the loan immediately. So also improve the financial image of the company. So they are saying, why should we reorganize instead of liquidating? So those reasons could be the same as any of those important. So why should you reorganize? So when you liquidate the business, it means you are selling it. When you liquidate the business, it means you are selling it or closing it down. So why should you close instead of reorganizing? So when you reorganize, it means you want to enhance the performance of that business. Also, you want to deal with the competition in the market. So any of them, if you either pick those importance or objectives, they will assist you to come up with that. Then, when you happen to go to Roman letter 2 of the same question, in relation to the corporate restructuring, discuss potential advantages of the company undertaking divestment of one of its divisions by means of sell off. So when you go through the handout, I've explained to you what we mean by the sell off. So if you go to page 3, you can see something known as the sell-off. So the advantages are there. When we explain the sell-off, they are saying that sell-off is also known as divestiture. It is the outright sale of the company subsidiary. So when you sell the company subsidiary, it is done when the subsidiary does not fit in the company, in the parent company core strategy. So one of the key advantages of selling it is when it is not able to fit in the parent company. Then also the market may be undervaluing the combined business due to lack of synergy between the parent and the subsidiary. So sell-off can also be used to raise cash. You see, that is the advantage. You raise cash to be used to pay the debtors and also to enhance, expand. So you read through that handout, just understand them, you will get some key knowledge for that. Then when you check the Roman is about the merger, there is also divestment. So read them. The merger is even up there. When you see about mergers and the merger, under that we have talked about the merger is where the company is now split into 2 or more separate business entities. Its aim is to create a new business entity, which will enhance the value of the original company. So I've given the reason for the merger. Those reasons are the same as advantages of the merger. So my advice for you, take time, you read that small handout. They test it almost every sitting. That small handout only, they will be able to come up with some questions on it. They will be able to come up with some questions on it, on how we should be able to deal with that element of the merger. So, apart from the handout I've asked you to go through it, I want us now to have a brief subtopic there. I have a brief subtopic as valuation of securities and business. That's now under the restructuring and organization. Under the restructuring and reorganization. Before you do the restructuring and the reorganization, you need to value the business. You need to value the business. So we now have a brief subtopic as evaluation of the securities and the businesses. Valuation of the securities and business. So we start off with valuation of the securities. We start off with valuation of the securities. Valuation of the securities. We start off with valuation of the securities. So under valuation of the securities, we shall only be in brackets. It will be ordinary shares. So valuation of the securities in brackets will be the ordinary shares. Will be the ordinary shares. So under valuation of the security as the ordinary shares, we write that ordinary shares are classified into two categories. Ordinary shares are classified into two categories. In terms of valuation as follows. It is classified into two categories in terms of valuation as follows. 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 So the first one will be constant dividend growth rate ordinary share. Constant dividend. Constant dividend growth rate ordinary share. Growth rate ordinary share. Constant dividend growth rate ordinary share. Constant dividend growth rate ordinary share. So under that, I will simply give you the formula on how to get the value for the share. So we have done some of those details when we are getting the cost of the ordinary share. We now simply make so PO will be equal to DO 1 plus G divided by KE minus G like that. So it is the same as D1 divided by KE minus G. So you remember PO is now the price of the share. PO is meant to be the price of the share. So DO is the last dividend per share that was paid. DO is the last dividend per share that was paid. Then D1 is the next dividend per share to be paid. D1 is the next dividend per share to be paid. Then KE is the cost of the ordinary share. KE is the cost of the ordinary share. Then G is the constant growth rate. G is meant to be the constant growth rate. G is meant to be the constant growth rate. Value of the share. So that is now how to get the value for the share. So I'll be doing a question on that to see how to get the value for the share. Then number two will be non-constant. Non-constant dividend growth rate ordinary shares. non-constant dividend growth rate ordinary shares. So we also have the non-constant dividend growth rate ordinary shares. So under that, we say that the value of the share in this case will be expressed as follows. The value of the share in this case will be expressed as follows. The value of the share in this case will be expressed as follows. So this is now how to get the value of the share. So value of the share will be given by present value of the future benefits during non-constant period. Non-constant period. Then we add present value of the future benefits. Present value of the future benefits during the constant period. So to get the value of the share, it will simply be present value of the future benefits during the non-constant period. Then we add present value of the future benefits during constant period. So I want us to use a question from your past papers to see how to get the value of the share. To see how you will be able to get the value of the share. So that question, I would like you to go to November 2018. November 2018, question number 3. November 2018, question number 3. November 2018, question number 3, part A. So go to November 2018, question number 3, part A. November 2018, question number 3, part A. Mine is on page 42. So that question 3, part A, it reads that the following are summarized financial statements as at 31st December 2015 to 31st December 2017. So you are given income statement for the year ended 31st December. They gave you 2015, 2016, and also 2017. Turnover is given, operating profit, interest, profit before tax, taxation, profit after tax, proposed dividends. There is also the retained profits. So, statement of the financial position as at 31st December 2017 has been given. So, non-current asset is given, the current asset is also given. Financed by ordinary share capital reserves, 10% long-term debenture is given, then short-term debts has also been provided. Then, when you go to the next page, additional information, note number 1. The stock market analyst expects the post-tax earnings and the dividend to grow at a rate of what percent? 25% per annum for the next 3 years. Thereafter, annual growth rate will revert to the company's growth rate and remain constant each year to perpetuity. Note number 2, the overall beta is 0.8 and the equity beta is 0.75. Then risk-free rate of return is 12%. Market rate of return is 28%. The current market price of the ordinary share is, it is given as 67.7, which is common dividend. Then the venture is 89.5x interest. The corporate tax rate is 30%, so required. Evaluate whether the share is currently overvalued or undervalued by the market forces. So first, you will calculate the growth rate. Growth rate, I have said that you can either use the retention ratio method or compounding method. So this one, you are to use the compounding method to get the growth rate. You are to use the compounding method in order to get the growth rate. You are to apply the compounding method in order to get the growth rate. So to get G, it is N and dN divided by dO, subtract 1 like that. So you go to the question 2015, you name it as dO. So 2015, you will name it as dO. 2016 will be D1. 2017 will be D2. So that means that to get your G, N is 2. N will be 2, and D2 divided by DO minus 1 like that. So first get the number of the ordinary shares because they were not given. Get the dividend per share. So number of the ordinary shares, number of the ordinary shares. To get the number of the ordinary shares. So go to underfinanced by. You can see underfinanced by. There are 30 millions for the ordinary shares. The bar value is 20. So get 30 millions divided by 20 to get the number of the ordinary shares. To get the number of the ordinary shares. So how many ordinary shares are we going to have? So there are 1.5 million ordinary shares. 1.5 million ordinary shares. So we require to get D2. D2 is the dividend per share in the year 2017. In the year 2017. So go to the question. Are you able to see the dividends? The proposed dividend for the year 2017. So there are 3 millions, there are 3 zeros at the top. Now divide by the number of the shares, which is 1.5 millions. To get the dividend per share for that. So that will give you 2. You also require DO. DO is the dividend per share in the year 2015. So you take that dividend, which is 2.1 millions divided by 1.5 millions. So now after that, get your G, which would now be 2. When you express it as a percentage, you are getting which percent? So confirm for me that growth rate. Get 19.5%. Online, you are getting which figure? Can you confirm so that we compare? Can you confirm? Someone has gotten 15.47. Others are saying 19.5. Majority are saying 19.5. Reconfirm. Remember, I had told you that figure will also be calculated as this way. 2 divided by 1.4 and 1/2 like that. I had shown you the two formulas on how to get G. So it should be 19.5%. It should be 19.5% as the growth rate. So because it is half non-code, so we start with, to get the value for the share, we start with the present value. So we have not also computed the cost of capital. So we also need to come up with the cost of capital or discounting rate. So cost of capital will be the same as our KEL, which we use CAPM. It is the risk-free rate plus in brackets expected return for the market minus the risk-free rate, and beta factor of equity for the delivered firm. So go to the note number 3. The question had given you a risk-free rate of return of 8. Then expected return of the market in the note number 4, it is 14. Also minus 8. Beta factor of equity was given in the note number. Are you able to see the beta factor for equity? Sorry, risk-free rate is 12, not 8. I was reading the other question. Risk-free rate is 12, not 8. Market return is 28. Sorry, this one is 12, like that. Now the note number 3, sorry. Note 3, the risk-free rate is 12. Then the market is 28. So the beta you got the note number 2, it is 0.75. 0.75. So what should it be? What should it be? Our cost of capital. So we get 24. We shall be able to get 24 by that. So in that note number 1, they had said that the stock market analysts expect that the earnings and the dividend to grow at a rate of 25% per annum for the next 3 years. That's now non-constant period. So present value of the future benefits during the non-constant period. During non-constant period. During the non-constant period. So let us get present value of the future benefits during the non-constant period. So we shall be having the year dividend per share, present value interest factor. So now the cost of capital is 24% for each year to get the present value. So we start off with the year 1. So our year 1 now will be 2018. Year 1 is the same as 2018. Year 1 is the same as 2018. So we had already calculated the dividend per share for 2017. So remember the dividend per share in the year 2017. We got how much per share? We calculated. We got 2. So that 2 is what is increasing by 25%. So 25% is the same as 0.25. So we get that value. To give you 2.5. Also go to year 2, where you get 2.5. You also increase it by 25%. 25% is 1 plus 0.25 to give you the value in year 2. 3.125. You also go to year 3, where you get 3.125. 1 plus 0.25, which is supposed to give us which figure? 3.9. 3.90. But I have it as 3.903, isn't it? When you round it off to 3 decimal points. So I would like you to check in the table, the single period table. What is 24% in year 1? In the single period table, what is 24% in year 1? 0.86.
8065.
Yes.
8065.
Yes. How about year 2?
0.65.
Then year 3? 5245.
Yes.
So multiply these dividends by these figures from the table so that you get your present value. Then add them together. Add them together to give you the present value of the future benefits during the non-constant period. During the non-constant period. Six point what? Online, you are getting what total? So that is now during the non-constant. We also want to add present value of the future benefits. Of the future benefits during the constant period. During constant period. During the constant period. So during the constant period, it is PO. So that means that our PO should be in year, our PO is the same as year 3. Even this one is the same as 3. Our DO is the last dividend that was paid, isn't it? So which is the same as our dividend in year 3. But we require them in year 0. So to convert them to year 0, multiplied by the present value interest factor, 24%. Year 3, like that. So our DO is the dividend in year 3, which was 3.9, because I'm using the note number 1 We are using the note number 1, where they say that thereafter. Are you able to see thereafter? Thereafter, the annual growth rate will revert to the company's growth rate and remain constant each year in perpetuity. So our DO is the dividend in year 3 thereafter. Then 1 plus G. So G is the growth rate, which we calculated. The company's growth rate, remember 19.5%. So 19.5% the same as 0.195 divided by. So this KE is that cost of capital of 24%. That KE is the 24%. So it is the same as 0.24 subtract 0.195. So 24% in year 3, it was 0.5245. So get the value of that share. So add them together now to give you the value of the share. Present value during the non-constant, then you add the present value during the constant. So add them together to give you the value of the share. So to get the value of the share should be equal to, during the non-constant, remember,
6.1.
it was 6.1.
2735.
But you round off to 4 decimal places or 2 decimal.
6.1 to 7.
4. Then we add. You're going to go back to
54.36. 54.3625.
So add them together. So your value in Abuja, a total of 60. So compare with the one that is given in the question. You see in the note number 5, market price per share in the note number 5. Market price per share. They gave you which figure? 67, so it should be X dividend. The one they have given is come. So you subtract the dividend of 2 shillings. Remember the 2 shillings. So mnakumbuka hiyo?
Yes.
Yeah. So the price of that share in the market is 65.7. Come dividend means it has included dividend. So you need to less the dividend for that year. Remember the 2017 dividend was 2 shillings. So the price will be 65. But in the market, sorry, the true value of the share is around 60. So that share is overvalued. That share is overvalued by the market forces. The share has been overvalued by the market forces. The share has been overvalued by the market forces. So the share is overvalued by the market forces. The share is overvalued by the market forces. Share is overvalued by the market forces. So Roman letter 2, they were asking me to advise. So you advise the investor whether to buy. So the investor should not buy. The advice is that the investor should not buy the share because it is overvalued. The investor should not buy the share because it is overvalued. You see, when you buy, you will pay 65, but the true value of the share is 60. So that investor should not buy the share. If you buy, you will pay how much? 65. But the true value, you can say it is how much? 60. The true value is 60. So that is now about valuation. So let us now go to the valuation of the business. Let us also write something brief about valuation of the business. Valuation of the business. Valuation of the business. So under that, we summarize that value of the business is equal to value of the business is equal to present value. It is equal to present value of all the future benefits. It is equal to present value of all the future benefits to be realized from the security. It is the present value of all the future benefits to be realized from the security. To be realized from the security. So let us get a question on that. So go to the sitting of May 2019. May 2019, question number 5, part B. We go to May 2019, question number 5, part B. May 2019, question number 5, part B. So that question for May 2019, question number 5, part B, they were able to say that Excellent Limited is considering acquiring Best Limited, a firm in the same industry, in order to consolidate its market share. A firm in the same industry in order to consolidate its market share. Best Limited has been less profitable, so it has paid an average of only 20% in the taxes during the last several years. So in addition, it has used little debt, having a debt ratio of 25%. If the acquisition will be implemented, Excellent Limited will operate Best Limited as a separate wholly-owned subsidiary. This will increase Excellent Limited gearing ratio to 40%. So the following is the forecasted financial data for Best Limited over the next 5 years. So they gave you year 1, 2, 3, 4 up to year 5. They have given you the net sales, operating cost, selling and administration cost, acceptable investment project cost. So additional information, they have said that note number 1, risk-free rate of return is 8%, and debt is considered to be what? Risk-free. Then expected return on the market portfolio is 13%. The firm levered equity beta after acquisition is estimated to be 0.8. Then note number 4, after 5 years, the net cash flows of Best Limited shall increase at a constant rate of what percent? 6% per annum in perpetuity. Then note number 5, corporate tax rate is 30%. Note number 6, the gross profit margin is 40%. Then they have also said that the firm incur fixed financing cost of 2 million per annum. The firm's equity shares and the bonds are currently trading at what? At par. So required. Determine the maximum price payable to acquire Best Limited using the discounted cash flow basis. So we start by saying that to get the value of the firm, so to get the maximum price to pay will be the same as the value of that firm. So value of the firm will be equal to present value of the future benefits. Present value of the future benefits during non-constant period. Constant period. Then you add present value of the future benefits during the constant period. So you simply add present value of the future benefits during the non-constant, you add present value of the future benefits during constant period. During constant period. During the constant. So we come up with the cost of capital. So first we calculate KEL. It is the risk-free rate plus expected return for the market minus the risk-free rate, then beta factor of equity for the levered firm. So go to the note number 1. Risk-free rate is given as 8. The expected return for the market is 13. Also subtract 8. Beta factor of equity was given as 0.8. The beta factor of equity was given as 0.8. But we require WSEC. We need to, because this is a company, it has both equity and debt. So cost of capital will be the WSEC. Cost of capital will be the WSEC. Weight of equity cost of equity for the delivered firm, weight of the debt. So KD must always be after the tax. So when you check in the second paragraph, where they say that in addition, it has used little debt, having a debt ratio of what percent? 25. So if the debt is 25%, equity should be 75%. So the weight for equity is 0.75, then multiplied by 12. Then the weight for the debt is 0.25. So KD is also given. KD, they said that the debt is risk-free. Are you able to see in the note number 1? Risk-free rate of return is 8%. The debt is considered to be risk-free. So the debt is 8 multiplied by 0.7. That is 1 minus the tax rate. So that should give you the WSEC. So roughly we use 10%. We shall be using 10%. Then once we have done that, let us now also prepare the cash flow statement. Let us also prepare the cash flow statement. Let us also prepare the cash flow statement. Also prepare the cash flow statement. We also prepare the cash flow statement where you check year 1, 2, 3, 4, up to year 5. So you prepare the cash flow statement. You prepare the cash flow statement. So the question had given you the net sales. The question had given you the sales. So year 1, you are given 50 millions. Year 2, 60 millions. Year 3, 75 millions. Year 4, 70 millions. Then 65 millions. So that question had given you the gross profit margin. Are you able to see the note number 6? Note 6, they gave you the gross profit margin of what percent? 40%. So when the gross profit is 40%, it means the cost of sales is 60%. So less the cost of sales. Cost of sales, which is 60%. We less the cost of sales, which is 60%. So what is 60% of 50 millions? 30. So this is 30 millions. Also get 60% of 60 millions. That one will be 36. 60% of 75 millions will be what figure? That will be 45. 60% of 70. The other one should be what? So when you subtract, you get the gross profit. You get the gross profit. So this one is 20. Next is what? 24. The next one should be the next one should be then so now we less expenses.
26.
Last one is 26. So now we less expenses. So among expenses, there is operating costs. So those operating costs, there is 5, there is 10, there is 15, there is 15, there is also 12. Then there is also selling and administration. Then I want you to go to the note number. Are you able to see the note number 7? Go to the note number 7. Note number 7, best in car fixed financing cost of how much? So fixed financing cost is interest. So we have interest. So it is the same every year. It is the same every year. So I would like you to subtract those figures so that we get the earnings before the tax. So that we get the earnings before the tax. So get the earnings before the tax. Earnings before the tax. Year 1 should be which year? 3. Year 1 is 3. Year 2 should be. Year 3 should be which figure? Year 4. 2. Then 1. Then you less the tax. 30%. So what is 30% of 3? 0.9. %30% of 2 should be 0. The next one should be 0.1 point. Then 0.6. Then, but also you see something up there where they had said that investment project cost. Even that one will less, but it is a capital expenditure. You see that investment cost. It is not taxable. You only subtract it after the tax. Yeah, so there is also investment projects or investment. We also less investment cost. So the investment cost is a capital expenditure. It is not taxed. You only subtract it after taxing. So this one is 0.5. So this one is 0.7. Then 1.6. Then 1.2. Also 0.2. So subtract now to get the free cash flows. Like that. So investment project cost is a capital expenditure which should not be taxed. The first one is 1.6. The second one is 0.7. 1.9. So I hope you are getting those figures, those who are online. So once we have done that, now we get the present value during the non-constant period. So now you get present value of the future benefits. During the non-constant. During non-constant. So we get now the present value of the future benefits during the non-constant. Those figures are being given by your colleagues. So it is you who is slowly, because your other colleagues are the ones who are giving me the figures. It is not me who is determining the pace of moving. It is the rate at which I'm being given the values. So you should reevaluate now your speed to cope with your colleagues. It is not me who have calculated those figures, have been given by your colleagues. So where are you? Are you anywhere where we are? Yeah, so you should reevaluate. You also move faster because you only have how many weeks to the exam? Wiki mbili ama moja. So there will be the year, then now the cash flows, then present value interest factor. The cost of capital we calculated it was 10. You remember? The 10, then also the present value. So 1, 2, 3, 4 up to year 5. So those cash flows are the ones you have just calculated. This one is 0.7, 1.9, 0.2, 0.5. So we go to the table, the single figure table. Go to the single figure table. So check 10% in year 1. Should be 0.9. How about year 2?
64.
How about year 3?
13.
Year 4?
8. 13.
68, 30. How about year 5? 6209. Yeah, so those figures are from the table. Multiply those figures by this amount. Get the present value of the future benefits during the non-constant, because those cash flows are not the same. That is now during the non-constant. So you have added what is the total? This one. Those who are online, I want you to give me your totals so that I use your total to measure the speed. Because it seems as who are in class, so I've been given, you are getting 3.90. Yeah, 3.90756. So even those who are online are at the same pace like us. So Adam, check that you also move at the same speed. So during the constant, we use the formula PO should be equal to DO 1 plus G divided by KE minus G. But our DO is now in year 5 as per this question. So even this one is year 5. So convert it to period 0. Get the present value interest factor. 10% in year 5. Like that. 10% in year 5. So this time round, your KE is the WSEC. The other one was valuation of the ordinary share, but this one is the valuation for the company. When you are valuing the company, your KE there will be the WSEC. So our DO is this 0.5 millions. 0.5. So I want you to go to the note number. I would like you to go to the note number 4. Are you able to see note 4? No, not 4. Note 4, they say that after 5 years, the net cash flow of Best Limited shall increase at a constant rate of 40%. It is on page 40. It is increasing at 6% per annum. So G is now 6. So that is 0.06. So I've said KE is the WSEC, which was 10%. So that's the same as 0.1 and also 0.06. Then 10% in year 5 is this figure there, the 0.6209. So get that value. So imekuja ngapi in total? 8 points.
6925.
So now you can get the value of the farm. So value of the farm. Wengine waliniambia ni 3.9. Now add. So that is now what should be the value of that farm. That is what should be the value of the farm. There are 6 zeros at the top. So now there are millions. So have them in 6 decimal places, no problem. Yeah, so that was the value for the farm. So when we meet, we shall do the question for August 2022. August 2022, question number 2, part B. August 2022, question number 2, part B. Number of decimal places, they should be 6 because they are in millions. The figures I've given you are millions. So this one is 0.5 million. So it is better you work with 6 decimal places. Unless now, so that question is on that. So when we meet in our next class, we shall do the question for August 2022, question number 2, part C, part B, sorry. Question 2, part B. Then I will do some other 2 more questions and we conclude that topic so that we start something else. So we can stop there for today. At the handout you read, that handout you read.